So y'all know the purpose of the channel is to help you maximize your banking relationships, make your banking relationships profitable so you can optimize your money and use your banking relationships to increase your net worth. In this particular video, we're going to be covering how the right investment can not only give you great returns in your portfolio, but also turn around and boost your internal score with the bank and maximize your relationship with that bank and help your money double dip. How so? By not only getting portfolio returns, but also turning around and have the bank pay you more on the rest of your money and charge you less on any leverage or debt that you take from them. This is how you optimize your relationships, and all of this is the foundation to how you increase your overall net worth. So in this particular live stream, we're going to be talking about silver and its performance. Silver has been taken off the last year or so as of early 2025. I've been fortunate to be investing in silver since 2015. I can say 2015, 2016, mostly in physical silver. And I'm going to be one of the first to admit that I'm a little late on the bandwagon jumping into the real opportunity with silver, which there's nothing wrong with silver itself as an investment. It's great. But the real opportunity is going to be silver mining stocks. And I'm not claiming to be an expert around silver. I'm claiming to be the expert in the banking field and banking relationship banking and how investments like silver and silver mining stocks can help you maximize and optimize your money. So as I stated earlier, silver's on the move, but a lot of people have been playing it wrong. So silver prices are rising. Mining stocks equal leverage on silver. We're going to spend a couple minutes talking about what the silver investment looks like, the landscape, why silver mining stocks, and then how to leverage this great investment opportunity to get the most out of your banking relationship and really put your money to work and increase your net worth, as I stated. So investing through your bank boosts your internal scores and your relationship benefits. And this is what we're looking to accomplish. So this is not one of those moves where your money is sitting idle, earning nothing, or whatever the case may be. This is one of those moves where your money, as I stated, gets to work twice, builds your portfolio, and then the bank starts to pay you for that increased relationship. So why is silver rising? And in particular, why isn't it done yet? Why is it not at the top of the market yet? Key drivers behind silver's move is going to be industrial demand. So think EVs, solar panels, AI, mining, crypto, and every single electronic, including the one you're watching me on right now, has a high demand for silver. And that's one major reason. The next is going to be inflation hedge and a weakening in confidence in fiat currencies. Silver, like its larger predecessor, or if you will, larger sibling gold, is one of those financial assets that people turn to when they losing confidence in the currency that their economy functions in. I'm in the United States. Most of you watching are in the United States. You're well aware, most of us, the basic conversation nowadays is how the United States dollar is continuing to diminish on the world stage as the world reserve currency and diminish in our eyes in its purchasing power, our ability to get the same amount of goods and services tomorrow as we got yesterday. So that's another reason why silver is taking off the way it is because a lot of us are losing a lot of confidence in our current currency. And we're looking for somewhere to park our money that's going to hold value. Silver is one of those options. Central banks and global demand for hard assets. Believe it or not, countries and central banks have been stockpiling gold and silver like crazy. And that's been picking up increasingly in recent years. And that demand in itself is also driving the demand in price or the spike in price for silver. So for those of you who aren't familiar, central banks are going to be something that the majority of countries around the world have. They are as described, the central bank to the rest of the banking system in that respective country. So when rates are being charged by your retail bank or a commercial bank, that rate is also based off the original bank from the central bank, because that's where your commercial or retail bank got their money from. So hopefully you understand it's like a wholesaler, retailer, and we're oftentimes the end user. So that's who central banks are. They have been buying gold in particular, but also silver and stockpiling like crazy. Governments have been hoarding and stockpiling silver like crazy. Even some retail banks like JP Morgan Chase have been stockpiling silver like crazy. All of this is driving demand. So an important distinction to help give context on why silver is performing so well and will likely continue to for the foreseeable future is going to be the fact that silver is a monetary metal and an industrial metal in high demand for both. And it's not mined at nearly the frequency, it's not coming out of the ground nearly at the frequency that it is that gold comes out of the ground. So basically what that means is it's in extremely high demand and there's not enough of it to go around, to put it in plain English. So silver hasn't even caught up to gold yet. And historically, when it does, it moves fast. Gold's price at the time of this recording is near $5,000, if I'm not mistaken, somewhere in that ballpark, which has also been up tremendously. It was up 45% in 2025 alone. But silver was up it was up 64% in 2025. Silver was up 145% in 2025. Insane. But it hasn't even started to close that gap with gold yet. And so that means another signal that silver could have a lot more leg room for the bull run that we're in and price demand for it. So why silver mining stocks can outperform silver itself? Basically, there's a leverage component. Silver up 10%, miners can be up 30 to 50% as a consequence. Why? Because fixed production costs and rising margins as silver prices climb. What does that mean in English? It basically means the mining company getting it out of the ground has a baseline cost of its operation to get the silver out of the ground. It's fixed. It already has that baked in. So when the asset is getting out of the ground is increasing in value, they're the ones getting it out of the ground and selling it to the next user in the chain. That could be, a coin, a mint. That could be, whoever is the end buyer, right? Somebody that's going to either make some monetary or industrial use out of it. So what happens is, let's just say it costs me $100 to get it, an ounce out of the ground. That $100 fixed. But the ounce is constantly climbing in price. So my spread from what it costs to get it done versus what I'm selling it for is broadening. That in itself can make the companies getting it out of the ground that much more valuable. And that is priceless. So the difference between physical silver and silver ETFs, silver mining stocks, juniors and major, it's juniors versus miners, right? So I want to keep this simple because I really don't want to try to come off as an expert on silver investing in that whole industry, right? But I do want you to have enough understanding to understand why it's still a potentially great time to get in on silver, though it's up nearly 150% or more at the time of this recording. You have physical silver investment, which again is up tremendously. You have ETFs, which can give you the opportunity to broaden out your exposure without physically having to hold silver, right? So you can, get in silver ETFs that track the price of silver, or, companies and private entities that may be holding physical silver and you can just kind of buy the stock to stake a claim in it. There's different ETFs and ways you can get in on silver without physically having to buy and hold it. Silver mining stocks are going to be, again, the companies that get it out of the ground. You have major miners and junior miners. Really simply put, one company is a larger, more established entity. First Majestic Silver might be an example. And then you might have a junior miner that's coming out of the ground. I can't think of one of those off the top of my head at the moment, but they are going to be a significant difference in the size of the operation. A lot of times your major miners are well-established, relatively large, relative to the space, large companies. The junior miners are the little guys that are just getting into the space, just starting to explore, et cetera, and getting investment from private investors and sometimes even major miners themselves. What does this mean investment wise, right? What this basically means is this segment, this industry, this market is not that big. Even major miners, their stocks individually are under $40, like $30 or $40 a share. Junior miners could be a couple bucks a share. So what it means is the barrier to entry to get in on these miners is relatively low for the potential upside. If I said 10% up for silver could translate hypothetically into 30 to 50% for a miner, and it was up 145% last year. silver itself. You do the math. So if that happens again through 2026, some kind of high level performance, even getting in now could still mean significant returns with miners, right? So miners don't just track silver, they amplify it. That's basically what I'm trying to say. They're not just some tracking the price mechanism. They're going to enhance or amplify the return or the performance of silver for the reasons I just gave. Now, let's get into the juicy part that I cover. Why banks love this kind of investment activity. Why? Banks don't just look at cash balances. Internal scoring systems factor assets under management, investment engagement, and portfolio size and diversification. Gonna say that one more time. Banks don't just look at cash balances. That's cool. Deposits are great. But internal score mechanisms that banks put together and score you by, they cover assets under management, investment engagement, portfolio size, and diversification. What it means is how many assets you have that the bank is holding on your behalf, or you're using their platform to hold or have. So that's the assets under management part, right? Investment engagement means if you're engaging in investments at all and on what level. Portfolio size and diversification. You know, do you have a $500 portfolio, a $50,000 portfolio, a $500,000 portfolio? And how diversified is it? Silver is an obscure investment. Most people are S&P 500, tech stocks if they're fancy. Nobody's talking about silver until now that it's going through the roof. I've been in the space since 2015, 2016, but nobody's talked about silver up until this point in time. And so that diversification can be appealing in the bank's eyes. Growth opportunities, and it stabilizes out because you're diversified in ways that should allow that portfolio to be stable in its growth. Banks love this. They love it. Why mining stocks help? Held inside brokerage accounts, which you can establish with a lot of the banks you guys bank at. They have internal investment divisions where you can set up brokerage accounts with them and buy these mining stocks. Increase total relationship value. You have skyrocketed your value with that bank when you set up a brokerage account and you start investing in something like silver that you might have plunged $1,000, $5,000 in, whatever the case may be, and it's going up high double-digit, even triple-digit returns on an annual basis. That's not going to last forever. Let's not be crazy. But it did happen in 2025, and it's not slowing down so far in the early weeks of 2026. All projections are covering a potential run-up still in gold and silver. So your relationship value to the bank is going through the roof because of the assets under management. Portfolio size is increasing. Count towards internal client tiers. So those of you who have major banking relationships, this could be Navy Federal, Chase Bank, Bank of America, you name it, these decent sizes to large institutions, you notice they always have tier levels in checking accounts, tier levels in savings accounts, tier levels in credit cards. They're basing those tiers on the features and benefits, the access to movement of your money, meaning like your Zelle limits could increase, how much you can transfer out can increase. They give you more broader access to move your money around and access it. Minimizing or eliminating any fees they charge you for more features and benefits. So as your relationship value builds with them, this is what happens as your tier level grows. Savings accounts and CDs that tier up, they pay you better in rates. This is how your money double dips. I got my portfolio growing. I'm investing in, great AI or tech stocks and silver. My portfolio is growing, and it's simultaneously getting me paid more on my deposits. My savings accounts now are getting paid. My savings balance is getting a higher interest rate just because my investment portfolio is growing under one roof. That's how your money's double dipping. So your client tiers, the same thing when you're applying for capital, credit cards, personal loans, personal lines of credit, mortgages, etc. Like as your auto loans, as you're growing your tier level with that bank, there's scenarios where they will literally take interest. They'll take points off your interest rate just because you're on a certain banking level with them. It'll be 0.25% or 0.5% off your rate, even for your mortgage in some cases. JP Morgan Chase's private client program, if you have so much in assets with them, and I'm talking maybe $200,000 or $300,000 in assets with them. They'll start to take whatever mortgage rate they're quoting you. They'll start to take a percentage off of that for the size of your relationship with them. Do you know how much in money that can save you on your mortgage? 0.25% to 0.5% on a mortgage could be tens of thousands of dollars over the life of that mortgage. So we're talking about serious amplification of your money. Like, this is optimization at its finest. So you no longer need just to be a depositor. You're an investor client. That's the creme de la creme for the bank. An investor client relationship value is the highest you're going to get. Literally, you can pay attention to the investment tiers. When you have so much in investments with a bank under management, there's no better you can do. That's including over deposits. Yes, deposits are great. Don't get me wrong. You can save a decent amount of cash and they're going to appreciate it and treat you better. But it's nothing like if you grow in a sizable investment portfolio with them. So this is a tremendous opportunity. So how this boosts your relationship banking and provides you with real benefits. So what stronger relationships unlock? Better pricing, faster approvals, higher credit limits, and more productive banker support and proactive banker support. Again, how does this boost your relationship with the bank? What real benefits does it provide? Better pricing, faster approvals, higher credit limits, and more proactive banker support. You can get yourself to the point where you have a dedicated banker. That's the kind of thing you want to achieve. Some of their higher ranking, more tenured, experienced, and achieved and educated bankers, they will dedicate one to you if your portfolio grows enough with them. And every institution's got a different portfolio size to reach those tiers. So it's not always millions of dollars to do this. You can accomplish this at upper 5 and 6 figures. And investing in something like silver with a decent amount of money and holding long enough to catch that top, if you can bring you there because it's doing phenomenal right now. So this is how wealthy clients bank at scale. The private offices, family offices, private bank, wealth management. This is what this looks like at that level. I'm teaching it to you as the everyday working person or the everyday entrepreneur. I'm teaching you how this goes. Because if you can master it here, that's how you can get yourself to a private bank type level. Because the bank is where your money is optimized. It's where your net worth really grows. What you're paying on your leverage, what you're paying for debt versus what you're able to go out and accomplish with that debt, the rates you're getting on your savings, the expert guidance that keeps your portfolio growing, all of that's happening at the bank. And most of you are sitting blindly and idly on it. And I'm trying to position you. So banks treat clients different when assets are involved, period. You're on a whole nother stratosphere in the bank's eyes. Walking in and just cashing your check, nobody knows who you are, or maybe a couple of tellers recognize you, to a dedicated banker, manager working with you by first name basis. Oh, I need to get that wire transfer. Oh, no problem. Let me get you in with Daniel. Let's get that done for you. Versus walking in, cashing a few checks, and then you got that big transaction you need to get done. And they're like, yeah, you need to set an appointment. Please go. Like, bye. Why are you in here again? Like, you're broke. Bye. And I'm not trying to be, insensitive or unempathetic towards the working class or whatever. I'm just being honest about how banks look at their clients. It is what it is. So you are going to get treated totally different if you can start to invest in asset opportunities like silver and let it take you to these different tier levels in your bank. So use your bank's brokerage platform. That's how you're going to execute this. To wrap this up, we're going to watch a quick video towards the end of this to just drive home silver's potential future performance. So y'all hang in for about 3 to 5 more minutes, and I'm going to wrap this up and let this gentleman break down why silver has a long way to go. So use your bank's brokerage platform, whether it's Navy Federal, JP Morgan, Bank of America, Goldman Sachs, wherever you're banking, PNC, wherever. Use their brokerage platform. Get off the Robinhoods, people. Get off the M1 Finances and Robinhoods, because these goddamn content creators been selling y'all these referral links and you're getting no recognition for it. You build these portfolios up with these off-end fintechs and there's nothing else they can offer you. You're missing out on all the expert advice, all the great rates and returns on your deposits, all the features and benefits to move your money as you need to do. You're missing all of that because you're on freaking Acorn. Like, come on, bro. Get to a real bank and start your relationship on their brokerage platform. You'll get treated much better and get way more benefits for the same effort. Use your bank's brokerage platform. Buy silver miners. Do your research on top performing silver miners, and look for top silver miners and look for major silver miners and do your research. If you would like, comment down below if you'd like me to dig a little deeper into the potential miners that could make sense. Not an expert there, but I have some familiarity because I've been investing there for a while. ETF or individual names, take your pick. You can pick entire ETFs that have baskets of silver miners, or you can pick individual companies if you do enough research. Keep it compliant and simple, long-term allocations. Do not try to go in there and start day trading, people. Speak for yourself, whoever you want to follow, whatever you got going on. But listen, if you're not a real professional, you're not licensed, or at least have genuine experience training or mentorship, genuine real mentorship, please don't go in there and start trying to trade. Like, just get you a handful of companies or ETF with a basket of companies that you do some basic due diligence and research on, and get in with them and put your money in and sit it and forget it, and maybe do some recurring transfers in. Don't try to be a genius trader. Please don't try to do that. Just set up a nice compliant long-term allocation that can ride this wave for a while and let your relationship, your portfolio, your net worth, and your banking relationship tiers grow. That's all. Don't complicate it. So same bank, same login, completely different relationship. That's how this goes. Let's take a look at this gentleman. It's only about 3 minutes, y'all. We're going to take a look at this gentleman, break down a compelling argument of why silver may have a long way left to go. Let's take a look.
How the bull market is accelerating. In the middle of 2025, these solid bars here were what gold and silver had returned in the first half of 2025. And if you projected out the same growth by the end of 2025, it would have been the top of these two lines. However, in the second half of 2025, gold and silver did better than the first half. So that's the acceleration. And they finished the year around 64% and 146% for gold and silver, respectively. So that's why this red line goes so steep upward. And what I'm expecting is 2026 will be even higher than 2025 because we get the biggest move towards the end. And I don't think we're at the end yet. So I would expect these returns in general to keep getting bigger until the end of the bull market. And so there are three key takeaways you have to understand on the differences between companies and monetary metals like gold and silver. The first is valuations. So company valuations rise with productivity and fall with inefficiency. Very important, and it's intuitive. However, monetary metals rise as trust erodes, and they fall as confidence returns. It's a very different dynamic. Second, what are the limitations to those valuations? What are the maximums? What are the minimums? Well, companies are bounded by real world limits: people, capital, time, coordination. However, monetary metals like gold and silver are bounded by human perception, fear, belief, credibility. And this has implications on how fast those valuations can move as well. So the third piece here is speed. Companies accrue value at the speed of human organization. That's fairly slow. Monetary metals accrue value at the speed of collective realization, the speed of thought. So metals can be repriced very quickly. If enough people realize that the dollar or institutions are not trustworthy, the price of metals will shoot up. So if I don't believe that the dollar has any value and you give me a choice between 1 ounce of silver and $100, well, I'm taking the silver. If you then give me the same choice between an ounce of silver or $200, I'm still taking the silver because I don't believe that the dollar has value. And so if you give me the same choice, an ounce of silver or $300, again, I'm still taking the silver because this 300 lies isn't really better than 200 lies and so on. And so that's why the price of a monetary metal can move so quickly, whereas the price of a company realistically cannot. So getting back to the sentiment here of investor psychology is wild. Yes, it is. And people are expecting silver to go to $500 an ounce by end of year 2026. Ha ha.
Pay attention.
What would be reasonable? Well, what if we go back and look at the previous bull run in silver and then just take the same numbers and apply them to today? That seems fair. That's the one reliable data point we have. So let's see if history repeats itself. What do we get? Well, here's what happened in 1979. So yesterday's closing price was yesterday's closing date was January 22nd. Okay, so that was 96.83. Let's go back to the 1979 analog of January 22nd. It was $6 an ounce for silver. By the end of that year, 1979, the price was $32.20 for a return of 409%. Now, if that same thing happens in 2026, right? So it's not some hypothetical thing that one day could happen. This would be just if history repeats the same return, what would that price have to be at the end of 2026 in order to mimic the exact same return of what happened at the end of the previous bull market? Well, he's right. It wouldn't be this ludicrous, insane $500 an ounce. It would be the much more reasonable 492.
Mic dropped. Mic dropped. Silver isn't done. Miners offer leverage. Banks reward investment relationships. That's my closeout for y'all. Like and subscribe. Like, comment, share, subscribe. It gives you the option. Boost the video. Those of you who watched it live, go back and like the replay. Comment silver down below if you want me to follow up with potential specific miners that may be of interest for you going forward. If you caught this all the way to the end, comment silver down below, comment it on the replay if you're interested in me going into a deeper dive on how you can leverage silver miners and specific ones with your banking relationship on their platform to grow your portfolio and grow your banking relationship. Comment it down below. So all my pioneers, welcome back. To my new viewers, welcome in. I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.